Hello trade pros. In today's video, our junior trader Victorio is going to talk to you about credit spreads. Credit spreads are an option strategy that can help you generate income on a weekly basis with a fixed risk amount. In the summer, this is one of our favorite strategies, and we're going to explain to you how to set it up, how to use them, when to execute the strategy, and when to get out and manage your risk. Before we get started, I just want to give you guys a quick heads up. When we were recording this video, the audio was picked up from the wrong microphone. However, the content was so good that we figured we'd bring it to you anyways. I did a little bit of sound editing, but just a heads up, you might hear a little bit of background noise. Thanks for bearing with us. Let's jump into it.
Hello YouTube, it's Victoria from Trade Pro Academy again, and today we have another video for you guys. I'll be doing a little introduction on credit spreads in this video, why we use them, how we use them, what underlying assets we look at when we do write them, and how to write them using Interactive Brokers, which is the screen you guys see right here, right in front of me. So first, what are credit spreads? So this is an option strategy that involves selling and buying an option of the same class, either puts or calls, and on the same expiration date at different strikes. So when you write a put credit spread or a bull put spread, you are looking to sell the higher put strike and buy the lower put strike, creating a credit into your account. The reason for this is that when you sell the higher put spread, this generates a larger credit than the debit you would pay by selling the lower put strike. The max risk is capped at the difference between the two strikes, while the premiums received is your maximum reward. So when writing a call credit spread or a bear call spread, you will sell the lower strike and buy the higher strike call. The risk and reward work in the same way as they do on the put credit spread. So the idea of the credit spread is to generate a premium as long as the underlying asset price expires either above or below your spread, depending on what kind of spread you write. So you want to expire out of the range of the spread and not in between the two strikes. So let me go ahead and show you an example of that. So right here on Interactive Brokers, we'll go into, let's use the S&P 500 ETF, the SPY. So right on the screen right here, you see Interactive Brokers. This is the SPY or the S&P 500 ETF. These are all the option strikes here. And I want to demonstrate how we construct a credit spread on this. So we're looking for maybe a week's worth of time value on it, because on a credit spread, theta works with you, so you don't have to have 30 days of time value in general or more. You want theta to burn out the position so it expires pretty much worthless. So you do collect the max premium. So right in here, so let me show you guys an example of what a credit spread would look like using TradingView first, then we'll go into Interactive Brokers. So right now the SPY is trading at 271.43. So if we were to assume, after we've done all our analysis, that this bullish trend will continue upward, we want to write a credit spread underneath right here, or a bull put spread, so that when price continues upward, it shies away from our credit spread, and by the end of the week we do collect the allotted premium. So when we do write the bull put credit spread, we're looking to sell a strike around this level and buy this strike right here. These are both put options, and when you do sell a put option, you want the price to go in the opposite direction or up, away from this put strike. We cap the risk by buying a put strike underneath, because if we just had a naked put out here written and price continued to drop downward, the risk is pretty infinite. Well, not infinite, it's capped at whatever the price of the ETF would be, so around 270 per contract, so that'd be a lot of money still to lose. So we do write a put option just underneath to cap the risk. Now, assuming that the trend is downward, and we do assume the SPY will continue its downtrend, we would write a bear call spread. So we would sell the call above here at the 276 level, and we would buy a call right here. So the general idea is the premium of the lower call or the higher put would be greater than the premium paid for the higher call or the lower put. So let's go into IB and show you guys what that kind of looks like. Assuming that we're writing a bear call spread, we see that the price is around the 274 level, 273, around this level. This is the current market price. So we are looking to sell the higher call and buy a call just above that. Did say that around the 276 level would be a solid short call position, and then we go in and look to buy a strike just a point move above it. So our strategy builder constructs that. So we do have 7 days of time value. This is a weekly or bi-weekly income generating strategy. Right here, as we can see, we have a bid to ask. They are negative because they do generate a credit, and when you do set your limit, you would want to look at the mid price as your limit. So the bid is 8 cents while the ask is 6 cents. So the mid price would be 7 cents. So that'll generate $7 per contract, which isn't much, but we generally like to do credit spreads in denominations of 10 or more. So when we submit our order, you might be thinking $1,000 of risk for $70 of reward doesn't seem like that great of a deal, which it isn't. So we would look at different strikes maybe. If we're more inclined on the bearish side, we can go a little above that. So that wasn't a good strike. Let's go a little higher. Sell the 275s and proceed to buy the 276s. What does that generate? The mid is more to our liking here. It's at $120 per $1,000 of risk, which is a little more acceptable, but again, you guys might be thinking that's a little outrageous. The risk to reward ratio isn't the best, but once you go into here and you submit the order, you will see that a little confirmation comes out right here, and as you guys can see, our max return is $120 while our max loss is $880, which is the $1,000 minus the premium received. Right here, you guys can see though, there's an 81% chance of max return while a 13% chance of max loss. So generally we want to look for a max return of over 90%, over 95%, so this might not be the best trade as S&P 500 SPY ETF is pretty bullish. So if we do go onto the opposite side and look for a bull put spread, we might find a better possibility. But again guys, go into TradingView, do your analysis before constructing these spreads, and this is a very viable option when looking for steady weekly income or bi-weekly income. So that's mainly why we use them. We're starting to enter into the summer market, which tends to be a little slower. Volatility kind of starts to drop off. So we like to generate weekly income or bi-weekly income using these credit spreads, or even potentially iron condors, which is the combination of a bull put credit spread and a bear call credit spread, which squeezes the price right in between, sandwiches them in. So it looks like this guy's right here. So you have your bear call spread, price is doing something like this, and then at the bottom you write your bull put spread. So you generate a premium from this spread right here and a premium from this spread right here. Let's say you have $150 of premium from this spread and $120 of premium from this spread, and this on a weekly basis. When they expire together at the end of the week, you do collect $270 worth of premium for about $2,000 worth of risk, maybe even less, between $2,000 and $1,500 of risk. But again, your max return percentage should drastically outweigh your max loss percentage. And the beauty about iron condors is that you cannot lose both ends of the spread at the same time. The price cannot expire in between both spreads at the same time. So we do like to rate these weekly credit spreads to generate premium of between $100 to $200 a week per 10 contracts about. That's our general rule. In most cases, we look for a 95% probability that we will get the max return on expiry. So guys, if you do implement this properly, you could end up potentially gaining $5,000 to $1,000 extra income each month. So coming back and looking at the TradingView level, it is kind of topping out, so maybe we can get some strikes a bit lower and write our call credit spread a little lower, maybe into this high right here. So we'll go into IB and look at the 274 level, see if that gives us a better probability. So we go in here, we sell the 274, buy the 275. We'll be generating $200 of credit right here, that's the midpoint. So we go into our limit here, 21 cents. Which is the midpoint between these two. Impact on margin $1,000. So submit the order and we will see how the option strategy has been built. Max return probability of $210, only at 73, so we've decreased. The kind of indicates that the trend is pretty bullish. Our max loss would only be $790, but again, that's a 19% chance. We don't really like that. We're looking for something in the 90% probability range, maybe go into a bull put spread. If there's nothing on a certain ETF, guys, you can go into other ETFs. We do like to look at IWM, which is the Russell 2000 ETF, and Triple Q, which belongs to NASDAQ. So we urge you to do your analysis on TradingView because the platform is a little better. We do like that a little better. And then go into IB to do your actual option strategy building. So let's do one more example, then we'll wrap it up. I hope you guys enjoyed that little credit spread intro. If you guys want to see how iron condors work in a slower market, shoot a comment down below, but let's continue right now. We do like to write credits on the indices because again, they do get slower during the summertime. Stocks in general on their own could be a little more volatile, so we don't really like to chance it like that on a credit spread because it could end up burning you. So guys, right here we're looking at the IWM, the Russell 2000 ETF. Right here, as you guys can see, we're on a bullish trend upward, so maybe doing a bull put spread on this wouldn't be a bad idea. Again, this is just for demonstration purposes, guys. This is not in-depth analysis, nor are we going to submit this trade. I just want to show you how this is done. So let's say we find some support around here at the 161s, 159 level, around there. So let's go and construct our bull put spread. Back into IB we go. So right here I have this open, a 7-day expiry, May 25th expiry date, which is in a week's time. So let's go ahead and construct this at 161. We can sell these. It'll come up in our strategy builder. Then we will buy the 160s. So let's see what kind of premium that generates. That generates 23, so 23 cents of premium, which is $230 for 10 contracts. Bump that quantity up to 10. So let's submit this order and see what our probability is and if this is a worthwhile trade. So again, our max risk is capped at $790 here, and our max return is 210. But the percent probability chance of winning this max return trade is 67%, which isn't the greatest. So let's go ahead and terminate that. Maybe a little lower. It is pretty bullish, so we want to continue with the bull put spread. If we sell these 159 halves and then buy the 158 halves, that'll generate us 11 cents, so $110 on 10 contracts. Let's go in here, and our probability does increase up to 85%. Our max return will be $90. Our max loss will be $910. Again, that's not really worth it, guys, but the probability of success is climbing a little higher, but for this return it's not really worth it. So again, guys, generally we like to do these trades on Sundays when we do actually have a full 7 days until the expiry or around there. So that was a general idea, guys. On my IB right now, I do have some credit spreads. I am taking advantage of this. My IWM spread actually expires today, May 18th. Right here I have an SPY May 25th expiry bull put spread. Look for probability that is in the 90% range, a max return of at least $100 to $150. This is a pretty good passive income generator, which you can do weekly or bi-weekly, especially during the summer markets. I hope you guys enjoyed the video. If you have any questions, plop them down below. Again, this was Victorio from Trade Pro Academy with a credit spread tutorial video for you guys, how we use it, what they are, how to implement it on IB, and how to generate passive income during the summer markets.
That's it for today's session. I hope you guys have enjoyed learning how to use credit spreads. Our Swing Trader subscribers have an opportunity to get an email on a weekly basis with some low risk, high opportunity trade ideas using credit spreads. If you want to check that out, click the link in the description below. There's a 14-day money back guarantee, so this is a risk-free proposition. I'd love to see you guys on the email list. We send out some of our best trades on a weekly basis every Sunday. In addition to that, we also provide you a daily update so you know what trades we like, which ones we're getting into, and which ones to avoid. Thanks a bunch for tuning in. Have yourselves a great day. Please comment, like, share, and subscribe. We got a lot of awesome content coming your way. Thanks a bunch and goodbye.